Well, hello. We're going to be drawing something new here where I'm going to be doing, I would say, some little bit of short recordings. I have had a lot of requests lately to share some of the informations that I have been doing in some smaller groups or in some presentations, also on quite a few of the podcasts. We're going to try a little something different. I'd love to get your comments and your feedback if there are some other topics that you would like to see going forward. What we're going to do at this point is I'm going to do just a little bit of screen sharing. And with that sharing, you will definitely enjoy. And it answers some of the questions that I have. One of the feedbacks that I get, and some of these are the questions that I get over and over and over again. And I thought we'd take just a couple of minutes and go over what I think are the five entrepreneurial mistakes that you need to avoid making. And they're just things that I see over and over. So let's take a minute here and we're going to go through these and we'll see if you agree. Do you have some other ideas? And put them down in the comments. Well, with many entrepreneurs that I work with, when they are starting to add staff, they are just blowing it when it comes down to calculating the correct cost of the employees. And this is really important. Part of the reason for that goes along with, let's say that you have an employee and you've done the normal things. You've gone down and you've looked at the hourly rate that you're going to pay them. And you know that you have to match Social Security and your Medicare. And you know that there's unemployment that you generally have to pay that is on a federal level and then is also in your local level. And that rate is going to vary by your experience and by the job categories. So that's a number. Most of you, and you're going to have work comp insurance, you're going to think of that. Are you doing benefits? Now, you may have health insurance. You could pay for a little bit of life insurance, whatever the case may be. I've seen perks that it could include cell phone use. That's one that's common. It just depends on what your dynamics are. And I'd say those are the ones that you think of right off the bat. But what happens is that when you do that, you really haven't calculated the cost of your employee. And for some of you, you are doing things on a contract basis. So again, you can use this for an employee, but understand employee and contract worker are not interchangeable terms. But for budget purposes, we're going to look at what these positions actually cost. Now, you've already worked up how much you're going to spend on, the salary, Social Security, Medicare, unemployment, and your benefits. But now I'm going to bring you into a different reality check on things that you are not even thinking of. Did you put travel and training into the budget? Because if you want your employee to do well or to do better or to increase the responsibilities, all of us have got to invest in training. So we need to add that into the budget for that employee. Maybe there are continuing education hours, something that they need to do once a year, once every couple of years, but it needs to be added into the cost of maintaining that employee. What about the tools that are required for them to do the job? Now, that one is going to catch some of you by surprise because, oh, well, I have that in another category, or maybe you don't. So for example, if I have an employee that has to have a computer, I am going to have to put into my budget, well, what do I need to do? Do I have to replace that computer every 2 to 3 years? Well, that's a cost associated with working in that position. What about other small tools? Do they need a copier? Are they on an assembly line and there are specific pieces of equipment that is exclusive to the use that they need, which can dynamically change what the cost of an employee is because of the items that you need to give that employee to support their ability to produce whatever it is that you have hired them to do in that position. Here's another one most of you are forgetting. If you happen to have employees and you're in a brick and mortar or some type of a location, are you accounting for what the overhead cost is for the amount of space that they take up at that point? I bet you're not. Now, let me give you an example, just because I like round numbers. Let's pretend that your building space is 100 square feet. It's just a number. Let's pretend that your employee takes up 10% of that space, or out of your 100 square feet, they take up 10 square feet. Very easy math. Let's pretend that it costs you $10,000 a month for that space. And in order for your employee to produce or do whatever the job is you've required, They require 10% of that space. So an additional $1,000 a month goes into the overhead for the employee to operate the space. So do you see a completely different dynamic happening here on pricing out what I believe an employee costs? Now I'm looking at, the basics that you usually have, but now we've gone into what about their tools and training? We've got to add that. Then I get into what is the overhead cost for where they're setting. Now, if you have a contract employee who is handling work that is off-site, that's not an expense that you're going to have. But what happens is that I can very easily take a position. And again, we're going to take a real easy number. Let's say $10,000. It's not realistic. It may be $100,000 for you. But on that position, I may have thought when I did just the wages and just a little bit of insurances that it's going to cost me $10,000 a year for this employee. But when I add on those extra layers that I've just shared with you, that employee could go up to 150 to 250% of my $10,000. So now that employee may really be costing me anywhere from $15,000 to $25,000, even though I thought they only cost me 10. So do you see the difference there and why it's really important to work out some of these numbers? Because if I am selling the services of my employee, for example, I had one business that when they were selling a service, they had priced it at $150 and they thought that was a great number because see, that's what everybody else was charging. But when I went back and had them look at what the actual costs of the employee were, when we added in these couple of extra levels, they needed to be charging at least $198 an hour to break even. I did not say make a profit, break even. And so every time they were selling this 1 hour of service for $150, they were actually losing $49 every time they sold an hour of the employee's time because they weren't accurately accounting for what the cost of the employee's time was. Now they've got to increase their pricing over and above the $200 mark to make a profit, or they may look at it and determine that this service is not profitable to offer and we have to do something else. So do you see where that can make a huge difference? And that's one of the big mistakes that I see when you have employees. Now, this will apply to everyone, whether you rent or own a location. And you could use this for your personal residence. You can also use this for your business location. What I have found over the years and have developed is what I refer to as the 1% rule. The 1% rule allows us to decide whether we are better off to rent a location or we're better off to buy it. It's very simple. I don't care what the value of the property is, whether the value of the property is $64,000 or $6.5 million. It doesn't matter. We're going to take the value of the property times 1%. So, if I'm looking at it, for example, I'm using one here of $400,000. It's just a number. And out of that $400,000, if I can rent that location for less than 1%, which would be $4,000 a month, versus what it's going to cost me to own the location, then I would be better off renting that property and not taking on the responsibilities of ownership. When you get into the responsibilities of ownership, we're going to look over on our slide for our example. The building costs $400,000 to buy, and that triggers a loan payment, property taxes, insurance. Well, do you have grounds that have to be cared for? You're going to have to do repairs and maintenance. This is something that kills everyone. And I tell individuals you need to plan on somewhere between 3 to 5% is a normal amount of repairs and maintenance. But if you bought a fixer-upper, that could be as much as 10%. So in our example, when I've included ground care, repairs, maintenance, utilities, I've got a hypothetical $4,803 a month carrying costs on this $400,000 property. And I'm on the hook for everything that happens. If the sewers blow up, whatever happens, the roof partially gets damaged, I've got a water leak. It doesn't matter. As the owner, I'm responsible for that property. Now, if I had an offer to rent the premises for $3,900 a month with utilities included, I would rent in this example because renting saves me the difference between the 4,803 that it would cost me to be as owner at a minimum, minus my $3,900 a month rent. So I have gained $903 a month in my profits, which is just around $10,836 a year to be a renter instead of being an owner. Now, over 10 years, the difference to your profits could be over $108,000. Now, I know some of you are already thinking, oh, Amy, you're not even thinking about rent increases. Well, let's look at that. I did the math, and your rent would have to increase at least 23% before it would be equal to the costs associated with buying the property. Now, I've got some of you who are about jumping out of your seat saying, oh, well, the property is going to appreciate. I want you to show me in writing in any contract that guarantees you that that property is going to appreciate, because I don't see it happening. Yes, it does in some cases, but it doesn't in others. Now, with that, something you want to be looking at. And again, can you apply this on your personal residence? Absolutely. Or your business location. So now you've learned about the 1% rule. And generally in less than 15 minutes, you can decide on any property, whether you're better off to buy or rent, or to rent a similar property. So this is something that I see individuals really mess up on, and they spend way too much money on a location, and that takes the profits right away from your bottom line. Well, let's go to another point. Have you failed to draw up a funded buy-sell agreement for disability or death of your partners? Now, look, some of you have got partners. And do you realize that when something happens to your partners, you're going to get all new partners, and they may not be the ones you have chosen? So let me give you an example. I'm going to pretend that I'm in a partnership where I own 50-50, and we're going to say it's with Bob. We'll just pick Bob today. Bob and I are 50-50 owners of the business. And as long as Bob and I are getting along and we're both healthy and we're both alive, we don't have a problem. But you know what? Bob died on me. And when Bob died, he left his 50% of the business divided between his wife and his 3 kids. I just got 4 new partners in the business. They don't know anything about the business. They don't know how to do anything in the business, but they're now my equal partners. And I can't make a decision without consulting my partners, and we're all going along the same way. This will not work. Do you also think that my new partners at Bob's death want the same amount of income into the household that Bob was making, who was helping me generate it? It's not going to work. So think about that. Now let's go to the next phase. What if instead of dying, Bob was in an awful car accident? He had a brain injury. Bob's going to be off a long time, and he's never going to be the same, and he's probably not going to be able to come back in the business. Bob and I didn't have any type of a formal agreement or anything if this type of a situation would happen, because if we have got to appoint a guardian or we've got a power of attorney or whatever may happen, I again have somebody else in the business that is now in essence replacing Bob as my partner to manage the business. Now, if Bob and I had put in place a buy-sell agreement at his death, then at his death, we had already determined what the sales price was going to be. We probably have it funded with life insurance. And so that I can buy out his share of the business, I'll own the whole thing. I don't have to deal with the state issues or anything else. And it is a very neat and clean transaction. In the event of my death, Bob would have bought my portion of the business and would never have dealt with any of my heirs. Now, in the event of a disability, a lot of companies can put in place what's called a disability buyout policy. Now, if Bob had this awful injury that he had, but he's not coming back, maybe I've bought an insurance contract that says that if either one of the partners are unable to come back after an injury or an illness for 6 months or 180 days, that policy would pay me a lump sum. And let's say Bob's share of the business is worth $1 million. We're just picking a number. Well, at the 181st day, we apply for benefits on that policy because Bob has met the elimination period. There is a little bit of research that goes on within a very short period of time, usually within 30 to 60 days. The $1 million of benefits are paid out to me tax-free. And I use that money to trigger a disability buyout policy, and I buy out Bob's shares. I now own all of the company. Bob now has the money to reorganize his life or whatever needs to happen there. And I can go on and I can decide if I want to bring on another partner or if I don't. The other thing to keep in mind is most of us are not going to have $1 million laying around in the bank to just write a check to buy Bob out. If you were to go get a loan, what are the loan payments and interest? Will you be able to qualify? So it could be difficult to do a buyout if you didn't have the ready cash available to go. Now, to my advantage, if I bought Bob out, you know how much it cost me for $1 million? It cost me the few amount of insurance premiums that I paid over the years. And let's say that I paid $40,000. It's a number. I paid $40,000 and I did not deduct the expense so that I could get $1 million that was tax-free to buy out Bob's business. I'm now sole owner. And because I paid $1 million for Bob's half, I've also increased the value or the cost basis of my business. And I know that's a lot and a little bit, but I'm trying to give you a broad frame on why I see this is something that is not done often enough. And it has terrible consequences to the remaining partners. Now, if you do not have a partner and you are a solopreneur, then there are deviations or there are other ways that we do this where we may put those agreements in place with an employee or with someone outside the company who is in a similar industry or has an interest in taking your company over in the event of your death or disability. But you want to have options, and we definitely want to dispose of our business interests, and we want cash in the bank when we do it, or we want our heirs to have cash in the bank, and we want it to happen quickly. Let's talk about another mistake I see entrepreneurs make. Are you operating your business without a viable exit strategy? Now, some of you are going to say, mistake number one, well, you are the business. Everything happens because you produce it. Nobody knows everything you do. You haven't transferred any of the systems. So your business may not be sellable because you have purposely created it to not be sellable. We can fix that, but you have to be willing to understand that you are not the business unless you make yourself the business. Let's talk about mistake number two. You never decided on the day you open the doors how much you're going to invest in this company before it's too much. Some of you will have pride that will step in. Let's pretend that I wanted to open a company. We're going to, pull Bob back in again. Bob and I decided to open a company, and we both decided that we would put as much as $200,000 in the company, whether it was money we had in the bank or it was loans that we were able to qualify for and repay. $200,000 is how much we are each willing to put in the business. Well, we have spent most of our initial investment that we had put in the business, and it isn't looking really good. At that point, are we going to close the doors and say this experiment is over? Or are we going to make a decision to put more money in the business, and how much longer are we going to give it? Many of you will hang on to a business way longer than you should because you never opened the business with an idea of how much was too much and how much was enough to put in the business. So you don't have an exit strategy when things are not going the way that you plan to. And for some of you, it's a real revelation. I need you to look at the statistics of how many businesses fail within the first 2 years, the first 5 years. I want you to succeed. Everybody wants you to succeed, but not every business is going to be viable. Know where your stop loss limit is and exit before that. So what's another mistake that you don't have a viable exit strategies? Many owners don't sell their business at a profit because they think this is going to last forever. If you've ever done any investing at all, you often heard you want to buy low and you want to sell high. The same thing could be said for your businesses. When you start them, that they weren't worth a whole lot, but now you've built it up. It's a profitable company. It's attractive to buyers, and you can sell it at a profit. Take the money, go do something else. And you won't do it. You'll hang on to it. And then what happens is the profits start to wane, or maybe the lifespan of your business has ended. And now the value is going down and it's not as attractive anymore. And it may be very hard to sell, or you just may be at the end of the lifespan of the business. And I'm going to throw out some terms, and some of them are going to date me and some of them might make you laugh. But let's see if you can pick out any of these businesses that had a lifespan. When it was good, it was very good. But when it became past their lifespan, they were no longer sellable businesses. You know, it's been a long time since any of us used horse and buggies, and you could have been the best buggy whip maker in the world, but there's no demand for your product now. How many of you ever fought over Cabbage Patch dolls trying to get one for Christmas? How many Cabbage Patch dolls do you see now? What about pet rocks? Did any of you buy a pet rock that you kept in the box and you trained? Let's talk about the video age. If I say the word Blockbuster, does the Blockbuster video change come to mind? Oh my Lord, that was enormous. Can you sell a Blockbuster video chain now? No, the value was no longer there. Let's look at a Kmart store. Many of you shopped at Kmart's for years. Is Kmart a viable business model right now? Can you sell it? Probably not. So do not hang on to your business to the point that it is no longer a sellable business because it is past its lifespan. Now, the last mistake I put on here is number 4, and you are telling me that your business is your retirement plan, and I'm going to tell you it's not. You're telling me that on the day that you decide to retire, 20 years, 30 years, 8 years, I don't care how many years from now, that you're going to have a sellable business. And not only are you going to have a sellable business, but you are going to have a buyer ready to go to pay whatever it is that you want out of the business, that is enough money so that you will be able to retire at that point in time. Folks, it doesn't happen for many of the reasons that we have just gone over. So I'm asking you, did you open the doors, and are you operating your business now without a viable exit strategy? Here's another one. You never thought, let's move this down here so it's not in your way. You never thought about building your business to be sellable every day of the year. And I want that to sink in. Your business should be sellable every day of the year. So when you first start building your business, I want you to build it with, if you changed your mind or someone came forward and said, I'd like to buy your business, that it is sellable and you could put the money in the bank and you could walk away. Very different thought when you start looking about it. So if you had this qualified buyer show up in your business this afternoon, tomorrow sometime, would you be able to quickly present why your business is attractive, why they should hand you a check, and how fast you could exit and get out of the transaction? Some of you haven't even thought about such a thing. Now, I will tell you, if you have a qualified buyer come forward, they're going to want to look at your books. They're going to want to look at tax records. I highly encourage you to get a non-disclosure agreement in place so your data cannot be shared before you ever start showing and talking about some of these numbers. And it's okay to ask for some information on the buyer to make sure that this is a transaction that you want to even spend time on. If they're an unqualified buyer and they're just snooping, they have a credit score that is 500, they couldn't qualify for a loan if they wanted to, or if they could not show a letter from the bank that shows that, yes, they have $250,000 in this account that has been pre-approved for a business purchase, you may or may not want to go forward with the discussion. So don't waste your time either. But a couple of items that I put over on my list. Is your business profitable? Do you think a profitable business is easier to sell than an unprofitable business? I'd say yes. Is it turnkey? Do you have your systems down pat? Do you have them written down? Do you have videos of how to do specific things? What have you got that you could transfer the knowledge that you have in your business to a new buyer? Are your procedures documented? Are all income, sales, or other taxes up to date? Because in many jurisdictions, if your taxes are not up to date, then the ability for you to renew licenses and things with your business would be jeopardized, and those should be current. Do you have a stable employee base that could be retained? Do you have some loyal employees that if the money was there, they would stay with the business, or is it going to be a hemorrhage? And then again, you have a knowledge drain that could occur. Do you have a client database with all the contact information and ordering history and that type of thing? And that's going to vary based on what your business is. What about your suppliers? Do you have a list of your suppliers and contact information at your fingertips that a new person coming into the business, whether they were a buyer, your disability, or death, could step in and could handle that? Do you have proprietary recipes or formulas that would be a part of the sale? How are you going to handle that? What about accounts receivables? Are those a part of the sale? Are they all up to date? Or is one of the reasons you're having financial difficulty is because people are not paying you and you continue to work with them? What are the terms of any lines of credit? Do you have lines of credit in your business, but that's really has been guaranteed by your personal ability to repay them? What will happen to those? What about your phone numbers and logos or websites? Are you going to include those in the sale? Do you have detailed, written, accessible emergency operations plan for relocation in a disaster, a flood? Do you have an employee phone tree? All I have to do is look in the news, and between natural disasters, flooding, fires, hurricanes, severe storms, businesses can be wiped out overnight and the location no longer exists. What's your relocation plan so that you can be up in hours? That's a whole different topic that I work on too. Are you going to do a cash only sale? Are you going to do installments? What kind of collateral? Because if you decide to do an installment sale, let's say that you've turned this business over, you're no longer working in it, and they have made 6 or 7 payments and now they've stopped or they don't want to do this. Do you have to take the business back over on whatever shape they've left it in? You may not want to do that. An installment sale may not be an option. You may only do a cash sale or some other terms. Now, one of the things I recommend if you do an installment sale on a business is to put life insurance on the buyer of the business. Let me tell you why. Let's pretend that I have sold my business on an installment sale on a 5-year term, which means I am expecting 60 regular monthly installments to come to me for that business to be paid for. I'm going to say the person who bought it is Mary. Mary bought the business, but as a part of the contract, because we decided to do installments for whatever reason, Mary must submit to life insurance examinations, and Mary must agree that I will be the owner and the beneficiary of a $500,000 life insurance contract, which is the amount of the business sale that we have agreed to. Mary, as a part of the contract, is required to pay those premiums, and she will pay them to me, so I make sure that that policy never lapses. In the event of my death, I have put a backup owner on the policy. In this case, I might say that it was my husband, so that he would receive those proceeds if I died first. Why do I do that? If I don't have a contingent owner on the policy and I passed away before Mary did, then it would automatically revert to her ownership and she could change the beneficiary to anyone she wanted. We want to close that loophole so it doesn't happen. Now, we have this contract, and let's say in year 3, things have been going well. Mary's been paying on time. Everybody's happy. But remember those awful car accidents? Well, Mary was in one. Mary was killed by a drunk driver. Mary is not going to be making installments to pay me off on that business anymore, is she? But do you remember we had that $500,000 life insurance contract? Well, I get a copy of Mary's death certificate and I submit it, and the insurance company pays out those proceeds. Now, depending upon how the contract is written, I may retain all $500,000 of those proceeds, or I may pay out to her designated heirs any amount that is over the $500,000 that was needed to satisfy the remainder of the loan. Why have I done that? I've made sure that I get paid. In addition to that, in the event of Mary's death, did I have to try to deal with her estate? Did I have to run in and try to build back up the business or do anything else? No. All I wanted was my money to exit out of the transaction. So again, there's some things you can do there, but you need to have a plan of action. So is your business sellable every day of the year? And even if you had a buyer, I'm going to go back. Is your business sellable? And what's your plan to execute that? Well, I'm at the end of my 5, but are you ready to learn 3 more ways that I can help you accelerate your profits right now? Well, in the notes, you're going to see that you can go on to the link. And if you would like to download my digital book, 7 Solutions to Add $10,000 to $100,000 to your bottom line this year, to give you some other tips, then you can go there and get a copy of that instantly. Are you an independent learner and you want to look me over just a little bit more? Well, you can go on to the link and you'll see a variety of courses that I have. I do suggest that you go ahead and book a call with me before you pick anything up, because I might be able to help you or give you some guidance there. There's a little over, I think, 3 dozen or close to that there. So there's quite a bit to pick from. What if you have already figured out that you need my help? Well, there will be a link where you can book a 30-minute Amy Make Me More Money call. That's a $300 value. If you've watched this to the end, then that's my gift to you. Now, I am Amy Rose Herrick with Secret Profits. I hope you enjoyed this. I'd love to hear some of your comments. And as I said, we're going to be doing some snippets here going forward. This may be one of the little bit longer ones, but I appreciate that you have taken the time with me at this point, and we've had a little bit of fun doing some of the screen sharing to bring you some of the 5 mistakes that I see entrepreneurs make on a frequent basis, but I don't want that to be you. Have a blessed day, and we'll be back in touch soon.